Hello, everyone, and thank you for joining us. The Wall Street Blockchain Alliance is very proud to offer our latest webinar, IRS Clarity for Crypto, Navigating Staking Yields, Broker Reporting, and the New Compliance Landscape. Before we begin, a bit of housekeeping for today's session. Please keep in mind that this event is offered for general information and educational purposes only and is not intended to constitute investment, legal, tax, or accounting advice. Any views or opinions expressed during the event are those of the participants and do not necessarily reflect the views of the Wall Street Blockchain Alliance or our participants' firms. This webinar is being recorded. All attendees, you're really encouraged to submit questions via the Q&A. You will all be in listen-only mode, and of course, we will reserve some time at the end of the event to answer your questions. And with that, we turn it over to our esteemed host. Raj, over to you.
Thank you, Ron. Good afternoon, everyone. I'm Raj Mukherjee, founder and CEO of Bowden Advisory, a strategy consulting firm that helps TradFi fintech and crypto companies work through complex global regulatory, tax, and policy challenges. I am very honored to moderate this excellent panel. A little bit about myself. I came to this work quite unconventionally. I spent the first part of my career in traditional finance in places like JP Morgan, HSBC, and moved into crypto to head tax functions at Coinbase, Binance US, and Consensus. Most recently, I served as executive director of the IRS Office of Digital Assets, where I co-authored the digital asset broker regulations and worked with international agencies like the OECD and HMRC on cross-border frameworks. This combination of private sector operations and regulatory work has given me the opportunity and the experience to advise with clients that have regulatory complexities in the digital asset space. We have a very esteemed panel, as Ron mentioned, so I'll let them each introduce themselves. Over to you, Nick.
Yeah, thanks, Raj. Good morning, good afternoon, depending on where you're joining us in the world today. So my name is Nick Farr. I am the blockchain and digital asset practice leader at Forvis Mazars US. We are roughly the 10th largest public accounting firm in the US and also globally. I lead up our blockchain digital asset practice. I'm a CPA, have a tax background, and excited to speak with you all today. Jessalyn, I'll pass it over to you.
Thanks, Nick. I'm Jessalyn Dean. I'm the Senior Policy Advisor in U.S. Tax Reporting for Eligible. Bit of my background was in the mutual fund space for many years. After that with PwC, all in tax information reporting of all kinds of assets and payments. And then in the last 5 years, I've been focused primarily through my work with Legible on tax information reporting regarding crypto and digital assets. And prior to joining Legible, I was leading the implementation of 1099 broker requirements and CARF with one of the top 10 largest crypto exchanges in the world. With that, I will hand it to Daniel.
Hello, I'm Daniel Hoffey. I'm Senior Manager with AICPA with the Tax Policy and Advocacy Group. Right now, I'm liaison for our Digital Asset Tax Task Force and been working with a couple of the people on the panel on some critical digital asset guidance.
Thanks, Daniel. Before we get into the excellent conversation we have ahead, just some opening context setting. So we are, as we all should agree, a pretty interesting inflection point in crypto tax regulations, right? So for years, the industry operated in a fog of guidance gaps and enforcement uncertainty. That's finally changed in the last couple of years in a meaningful way. Today, we're here to discuss some recent IRS developments that dropped within the last few months, plus what's coming down the pipeline. These are no longer incremental tweaks. They represent perhaps some of the most significant coordinated push towards compliance infrastructure we've seen since the Infrastructure Act passed in 2021. Quick history lesson to frame this. The IIJ gave Treasury the authority to treat crypto brokers like regular brokers for reporting purposes. That kicked off about a 3-year rulemaking process, which I think we can all agree was quite publicly contentious and delayed. And obviously the DeFi regs went through their own arc. We finally got the custodial regs in June 2024. Now we're seeing some of the follow through, the rev procs, and that recently dropped on staking, for example, in November. And then the FAQs in October that some of the panelists will be commenting on. The other thing is the CARF regulations in the OECD that's gained some momentum. And then even though the US has been quiet and spoken of postponing implementation, the world is full on when it comes to CARF. And that's also not happening in a vacuum, right? The UK's FCA has been rolling out consultation papers throughout the year on a comprehensive regulatory framework. Dubai's VARA continues to refine what's become the world's most developed virtual asset regulatory regime, with everything from RWA tokenization to market compliance. And then Singapore's MAS, for example, just implemented major territorial scope changes effective June of this year, and is essentially closing on or minimizing regulatory arbitrage. Well, why does this matter? I think what makes this moment different is coordination. We're not just seeing isolated guidance. We're seeing the IRS work through complex technical problems in real time. What constitutes covered security? How do you harmonize domestic reporting with international frameworks like CARF? And these questions affect every player in the ecosystems, from retail investors to institutional funds to brokers building compliance systems, and of course the tax practitioners trying to advise clients through this. So our panelists bring perspectives from all these angles. Daniel from AIPCA, broker implementation, tax advisory, Jesselyn, and then regulatory navigation, and Nick is a star in that. So we'll walk through each development, talk about the practical challenges, and discuss what's still missing from the guidance. So let's dive in. Jesselyn, Nick, and Daniel, over to you.
So first, we'll be discussing the IRS's most recent digital asset guidance, RevProc 2025-31. If you could change the slide. As background, the White House issued a report earlier this year recommending that the IRS publish guidance addressing whether a trust would fail to qualify as an investment trust or a grantor trust if it staked digital assets owned by that trust. This issue was also brought up in the October 2025 Senate Finance Committee hearing on examining the taxation of digital assets. So RevProc 2025-31 provides a safe harbor for exchange-traded products that are organized as trusts and stake their own digital assets. Trusts that satisfy the safe harbor will not jeopardize their investment trust and grantor trust status. The purpose of this guidance is that many ETPs holding digital assets are structured to qualify as investment trusts and grantor trusts, although some are structured to be taxed as partnerships. While Subchapter M regulated investment companies are used for more diversified funds, ETPs are often used for commodities funds or spot crypto funds. The advantage of using a trust structure for a digital asset ETP is that the investors are treated as directly owning the underlying asset on a pro rata basis, and then they receive a pro rata share of the income and is reportable on a 1099. So simplicity is the key there. Because a significant benefit to investing in these products is the ability to stake their own assets, clarity around this issue of whether staking would blow up their investment or grantor trust status was critical. This guidance provides a path forward for both existing and future ETPs that will stake their underlying digital assets. But the safe harbor is a lengthy 14-part test. Also, I say existing ETPs because the IRS has afforded transitional relief to custodians to amend their agreements so that they can satisfy this 14-part test. And that's 9 months from the November 10, 2025 would be that deadline. And then before moving on to some parts of the test, note that the safe harbor does not address regulated investment companies. All right, so I won't go over all the factors of the safe harbor, but I did want to mention a couple key parts of the 14-part test. One is that staking must be directed through a custodian, and the custodian must have sole control over the exercise of ownership over the digital assets. But just like a grantor trust, the trust remains the owner of those digital assets. The trust can only own cash and one type of digital asset. A trust's digital assets must be indemnified from slashing or the forfeiture of locked up rewards for violating the proof of stake network's rules. Staking rewards after deducting trust expenses, they must be distributed in kind or as cash on a quarterly basis, and all staking reports must be treated consistently. And then subject to certain exceptions that are listed in that 14-part test, the digital assets being staked must be available to the staking provider at all times. And then on the next slide, we have a couple outstanding issues. For example, the RevProc did not address whether certain administrative changes would violate the safe harbor, such as changing providers or instructing them to run MEV Boost. Interestingly, this RevProc was drafted by Chief Counsel's Pass-Through Trust and Estates Division, so drafted by individuals well-versed in grantor trust rules and investment trusts. So it'll be interesting to see if some practitioners begin advising ETP custodians based upon grantor trust and investment trust guidance and precedents. One example is that just as trusts may have special trustees to perform certain explicitly authorized tasks, an ETP under the safe harbor must have a custodian grantor that may serve as the staking provider, or they can arrange for a staking provider. There's some parallels between the limited and administrative nature of the roles for both those special trustees and staking providers, and maybe guidance on whether a special trustee possesses dispositive powers or administrative powers can be instructive. Although it seems that the authority to replace a staking provider is administrative in nature, it is unclear. And custodians and their advisors will need to consider whether to include that power, with whom the power will be vested, and the breadth of that power. Similarly, if we look at MEV Boost issue, the MEV Boost issue, the primary question for investment trust purposes is the power to vary the trust's investment. And the primary guidance regarding a trustee holding a power to vary investment, it seems to focus on taking advantage of market fluctuations using the underlying assets or altering the underlying investment. Whereas as far as I know, MEV Boost seems more focused on the trust's ability to generate income rather than the ability to vary that underlying asset. Regardless, hopefully we can get some IRS guidance weighing in on these issues soon.
So Dan, just a quick question on some of the stuff you said. So the safe harbor requires staking to be directed through a custodian rather than a trustee, I think you said, and requires indemnification from slashing. So what operational challenges do you foresee in implementing these requirements, specifically for trusts that need to amend their agreements within that 9-month window?
Nick, Jesslyn, I invite your feedback on this one.
Yeah, I could chime in. I think the operational challenge is reading into the devil in the detail as to that staking provider and its relationship to the custodian and to the trustee. So there's some nuance in each of the 14 bullets that Daniel mentioned. The staking provider needs to it cannot be related to the trustee, but it doesn't say that they can't be related to the custodian. But then it does say that the staking provider needs to provide these services to other third parties that are not the custodian, trustee, et cetera, et cetera. It's trying to make sure that these are arm's length transactions. And so I think there's a lot of custodians out there that do also offer staking services. And I think that operational challenge will lay in those agreements and ensuring the disconnect of relationships and ensuring it's arm's length transactions.
Thanks.
And then some other outstanding issues are guidance on withholding and reporting of ETP distributions, namely the sourcing character of the income. Also, the incremental tax liability from the staking income distribution, and then the pass-through gain loss when the ETP sells the assets to pay distributions. Any comments on these two issues before we move on?
Maybe I could just add on that third bullet. It's not really it's not outstanding guidance that we're looking for. My perspective on this third bullet is really there's a lot of novice investors that bought up these ETPs and didn't really know from a tax perspective what they were buying. And they were surprised to have to deal with tax information reports that didn't go on 1099-Bs. And this is just going to get even more complicated for them, not realizing that even if they don't sell their ETP interests, they have underlying activity in the fund that they have to account for. And this staking activity just like amplifies that even further. So it's not a guidance issue. It's just an issue for investors to be aware of.
Yeah, as a practitioner, one of my favorite things in tax filing season is to review a 1099-B and see that our clients invested in one of these ETPs, and then to have a conversation with them and tell them, oh, by the way, the 1099-B doesn't capture all the information that you need to report on your tax return. We need to actually go out there and find this trust tax letter that has all this other additional information in there that may adjust your cost basis and proceeds. And clients are surprised by that, and they generally just assume that 1099-Bs are gonna capture all this information. Now, I've seen some 1099-Bs that are getting better and starting to capture some of that trust tax letter information on them, but for the most part, you have to go out there and grab that additional information on your own. I think another impact just in general to this safe harbor is something that hasn't been brought up is one of the requirements of the safe harbor is that the ETP can only hold cash and a single digital asset. And I found that interesting that the ETP could not hold multiple forms of digital assets and stake those multiple forms of digital assets. And the reason I'm bringing that up is because I like to kind of see, okay, well, how is this going to impact the rise in popularity of the DATCOs in 2025, or the digital asset treasury companies? So for a while, before we had this clarity from the IRS, I think that was a leg up that DATCOs had over these ETPs, is that the DATCOs could stake and pass on some of that revenue generation to their shareholders. Now, I think we're starting to see the difference between the ETPs and the DATCOs close. We're starting to see that gap close. And but because this safe harbor requires these ETPs to only hold a single digital asset, that might continue to be a gap that DATCOs can have over these ETPs, as DATCOs can own multiple forms of digital currencies.
An interesting point, Nick.
Hey, Nick, maybe you want to answer this one. We had a question from the audience. Does what you were just explaining, does that include stable coins, the requirement for the ETP to hold only one digital asset?
That's a good question. I'm not sure that I've dug into that. Generally speaking, the IRS views cryptocurrency digital assets as property, and stablecoin falls under that IRS 2014-21 guidance in the absence of any additional guidance. And we haven't received any guidance from the IRS saying otherwise. So I would think that stablecoins would be considered its own separate form of a digital asset. I'm curious, Jessalyn, if you have any different opinions.
I have not dug into it, but if Daniel or Raj have something else on it, it's a takeaway item. I'll probably nerd out.
Yeah, I think it's a good one for us to put our brains into offline. So, all right, I think we can move on to the next segment. Nick, I believe that's you.
Yep. All right, so now we're going to talk about Form 1099 DAs. These are expected to roll out for the very first time in the next couple of months before the February 15th deadline for transactions that occurred in 2025. So we're going to talk about some key deadlines, implementation challenges, and so on and so forth. So here we have a brief timeline. So starting in January of 2026, first and foremost, backup withholding is going to become effective for the first time for transactions that occur in 2026. Okay, the 1099 DA reporting starts for transactions that occur in 2025, but brokers had a 1-year grace period on the backup withholding. So that won't actually start until 1/1 of 2026. And that would be, for instance, when brokers don't have a W-9 or W-8 on file to determine if you are a U.S. person or not. And it could also apply if that broker receives a B notice, which is basically the IRS saying that the records the broker supplied to the IRS don't match the IRS records, and they weren't able to identify that person. And so those are a couple instances where backup withholding may occur. And then, beginning in January and February of 2026, we're going to start to see brokers issuing those Form 1099 DAs for 2025 sales transactions. Gross proceeds only, though. So similar to how brokers had a 1-year grace period for backup withholding, they also have a 1-year grace period for cost basis reporting. And there's also more nuances to that as well. We'll dig into that here on the next slide. And then starting on January 1st, 2027, that's when we'll start to see 1099 DAs for 2026 transactions that could include gross proceeds and cost basis for quote unquote covered securities. Now, that's why I said it could, I use that word intentionally, it could include cost basis. We'll talk about what a covered security here is on the right side of the screen. First and foremost, it has to be acquired on or after January 1st of 2026. So if you acquired, let's say, for example, Ethereum in a broker prior to 2026, but you sell it in 2026 or thereafter, it's still not a covered security. Brokers still don't have to report cost basis on those sales. They also, for a covered security, they also have to be acquired in that brokerage account and remain in that brokerage account in perpetuity. So let's say, for example, once again, I buy some Ethereum. This time I'm going to buy it after 2026. Okay, so upon initial purchase, it's a covered security. But in this example, I'm going to send it to my self-custodial wallet and store it in that self-custodial wallet for a time, and then send it back to the same broker that I bought it from to eventually liquidate it. That's not a covered security because I moved it off of their platform. So those types of transactions will also not have cost basis reported on them. And then, within the final regs, there was talk about customer provided acquisition information, or CPAI for short. Basically, I'm at a very high level, I'm oversimplifying this, but the final regs say that brokers don't have to accept any sort of information from their customers when it comes to identifying that acquisition information. They can, and if they do, really all it's going to be used for is for lot ordering. And so in other words, to know which lot was disposed of, whether on a FIFO basis, a LIFO basis, or a HIFO basis, that customer provided acquisition information is not going to be used for cost basis that is reported to the IRS. Okay, so customer may be able to go into their account and update some acquisition information, including cost basis, within that broker, but that's only going to be used for their self-reporting purposes. It's not going to be sent to the IRS. It's only going to be used for which lot was sold first or last, depending on which method you're using. So if we'll go to the next slide here. So let's maybe talk about some challenges. And actually, before I dive into the slide, maybe I'll pause and see if Jesslyn or Daniel or Raj had any comments on that last slide.
Maybe I would just add, and we'll get into this a little bit more, but on that slide, it mentioned brokers are not obligated to accept CPAI. It's optional. On the one hand, as a customer service, brokers should absolutely accept CPAI. That's a good thing for taxpayers to have 1099s that match the reality of the elections that they've made to dispose of cost basis. But on the other hand, the broker perspective, they've got a long list of requirements of things they're absolutely supposed to do, and a relatively short window to get it all done compared to what the traditional financial industry had many decades ago. And so there's a limited resources every day and limited people to get this work done. And you order things top priority, the lowest priority, and you attack the things that have a regulatory impact on you or a financial penalty impact to you. And nice to have customer happy, friendly things tend to go to the bottom. So we'll talk about that a little bit more, but that's just to explain why a broker may or may not accept CPAI.
Yeah, great point. Great point, Jesslyn. Ultimately boils down to a business decision, right? What are they required to do? How expensive is that going to be? And can they get it done in time? All right, so moving on, we have a list of some anticipated challenges that we are expecting as a result of these 1099 DAs. And these are all conceptual for the time being. When these start to roll out, I think is when we'll actually start to see what the actual challenges are when practitioners and taxpayers actually start to report these things. But conceptually speaking, first and foremost, many taxpayers and practitioners even are still unaware of Rev Proc 2024-28. And basically what that revenue procedure does is it provides a safe harbor for taxpayers to transition from the universal method of reporting to a wallet by wallet method of reporting. If you're not familiar with those terms, we could probably spend 30 minutes just talking about that alone. I'm not going to go into that level of detail. Just something to be aware of, that even if you as a taxpayer or your client as a practitioner didn't meet the safe harbor timeframe, which was generally speaking December 31st of last year, they still have to convert from universal to wallet by wallet, because in that guidance, the IRS essentially said, hey, we disagree with this universal method of reporting. You need to move to a wallet by wallet tracking. Second on this list is using specific ID. I think it's been very common for brokers or even crypto accounting and crypto tax softwares in the past to default a lot of their customers to a HIFO method. Generally speaking, HIFO, or highest in first out, is a form of specific ID. And taxpayers that may want to continue to use specific ID need to make that election or choose that method before they sell their assets. They can't do it afterwards. Now, we don't have 100% guidance from the IRS saying what exactly does it mean to make that selection beforehand. Could that mean, hey, I'm just going to email myself if it occurs self-custodially, or what about if it's with a broker? How do I let them know? I know that some brokers are allowing their institutional customers to make this election with them beforehand, but many brokers are not allowing their customers to do that if you're a retail customer. Now, there is guidance from and case law from the IRS essentially saying that you can have a standing order with them that lasts in perpetuity until you change it. So on January 1st of the tax year, I can say, hey, I want to specifically identify the highest lot to be relieved first whenever I sell an asset. And that remains in perpetuity, so you don't have to do it for every single sale thereafter. Now, in the absence of specific ID and not making that designation before you sell, it resorts back to FIFO. Okay, so first in, first out. Then next bullet point here is, kind of along the same lines of what we've been talking about. Taxpayer may have records that don't match what the broker has. So taxpayer may want to continue to use HIFO, but their broker doesn't accept that customer provided acquisition information, which could lead to differences in what gets reported to the IRS versus what the taxpayer has in their records. And then, we've talked about this a little bit already, but 1099s, these 1099 DAs will also be missing cost basis if they're non-covered security. Next slide.
So Nick, before you go to the next slide, you mentioned that many of these taxpayers are unaware or remain unaware of Rev Proc 24-28. Since you interact with taxpayers quite a bit, actually, and Jesslyn, you as well, what's some of the best ways to educate taxpayers about this change before they make these costly mistakes? What's the common misconception you hear when you speak to taxpayers on this issue?
Yeah, so whenever this Rev Proc first came out last year, we tried to do our best to reach out directly to all of our clients that we knew were impacted by this. So, we ran reports to see which taxpayers, which clients had checked that yes box on their 1040 tax return, or now it's expanded to even business income tax returns as well. And so we tried to reach out to them proactively, letting them know that this guidance had come time to line to help them prepare for this. In the absence of those that wanted to move on this and take action before the general deadline of December 31st last year, this is something that we're just going to have to bring up again and have that conversation with them and explain to them why this is important and what their risk is by not transitioning.
Yeah, and I think it's important also to understand some of the regulatory intent, right? Especially, and I think we're going to may cover it later on as to the information that customers were supposed to provide their brokers on the pre 2025, right, purchase on the lot selection, and then the IRS provided a year's relief. I think part of that goes back to the challenge of what or the point that Jesslyn was making is you know there are many things that the digital asset brokers are getting used to for the first time around in the sort of like three pillar of information reporting, right? The due diligence, the transaction monitoring. We talked a little bit about where the withholding would come and then the reporting. So I think that there was a general feel from the industry, and I remember having meetings where the industry came in and pretty large brokers came in and said, we're not technologically ready to have all of this information as part of a taxpayer's profile. The fear at that point was, what if the taxpayer sort of sells something in January 2nd and the information is not there? So I think that was a case where the IRS, acknowledged and agreed that it would be better to shift that release for a year to come in line with the fact that brokers are supposed to start tracking cost basis on 1/1/26. So you have the snapshot rule for the 1 year delay. So I think there's the rulemaking aspect of it, and then there's the practical implementation. This is probably why it's important to continue the public-private partnership and the communication with the IRS. So,
yeah, just to double click on that a little bit, Raj. I think what you're referencing is, I can't remember the notice number off the top of my head, but at the end of 2024, there was a notice that came out from the IRS that basically said, we realize brokers aren't going to be able to accept customer provided acquisition information right away. So taxpayers in 2025 can specifically identify in their records how they want to dispose of these lots, even if the broker isn't prepared for it. Do you remember the number of that notice off the top of your head?
I don't. Jesslyn?
I was smiling because I don't remember either, but we all talked about it a lot at the time.
Yeah.
Was it 25/7? It may have been that.
Ooh, that might be it.
Anyway.
And maybe I'll just add one more thing that, and we have another slide about this, maybe even next, or 2 slides from here. I still don't think there's an IRS FAQ about this topic, the RevProc 2024-2028. So this question of like taxpayer education, an FAQ is a really good start. I kind of made this joke in a serious way to someone at the IRS one day. I said, because they were saying, look, we put out, the guidance is out there. I said, yeah, but Internal Revenue Code has a much lower SEO than FAQs on the IRS website do. So when taxpayers are Googling this stuff, FAQs show up and your RevProc 2024-28 is much lower in the search results.
Yeah, that's a valid point, Jesslyn. I can only say for my former regulators at the IRS, the importance of FAQs has not lost. However, like anything that comes out of a regulatory body, the amount of resources needed to update even a single document and the rightfully set protocols that one has to go through means that oftentimes it takes a lot longer than the taxpayer may want or the industry may desire. So, to their defense.
Yep.
Nick, back to you.
Unfortunately, we all have the same 24 hours in a day, and we have to prioritize what can get done in those 24. So yeah, if we'll go to the next slide here. So some additional challenges that we're anticipating, also missing forms 1099. Well, maybe not necessarily missing 1099s, but missing transactions that don't appear on 1099s. So for example, if a client or a taxpayer performs transactions on chain outside of the broker's purview within DeFi, those are not covered within the final regs. There was a lot of misinformation that's going around earlier in 2025 when the CRA repealed the DeFi reporting regs. The misinformation going around was that, hey, no 1099 reporting at all. That's not true. Custodial brokers still have to continue to report transactions that occur within their purview, but the DeFi transactions do not have to be reported on a 1099. Some other transaction types that may not be reported on 1099, even if they do occur within a broker, could also be qualifying stablecoins if it's under $10,000 in the annual aggregate, or under $600 for qualified NFTs. You may also have a situation where taxpayer or a client receives a delayed Form 1099 because brokers have an additional year to report 1099s if they make a good faith effort. That's just for 2025. Okay, so just a 1-year grace period where these brokers can report those 2025 1099s all the way up until February 15th of 2027. So if you think about it, February 15th, 2027 is several months past even the extended due date for individuals and corporate taxpayers. So they could file their 2025 tax return, and then they could receive a 1099 even beyond when they file their extended tax return. Something to be aware of there. There's also a scenario where differences in time zones could create a scenario where a transaction that occurs on December 31st, where a taxpayer may be tax loss harvesting, actually shows up in the next tax period for their 1099s. So let's take an example. Let's say I live in California and it is 10 p.m. local time in California, Pacific time zone, and I sell my Ethereum to harvest a loss. My broker may be using Eastern time zone for 1099 reporting. That would be 1 a.m. on 1/1 of 2026. And so in their records, that transaction would show up on a 1099 DA for 2026. So there's going to be some reconciling differences that could occur between what is actually sent on a 1099 DA versus what's actually in the taxpayer records. And if you take anything away from this section of today's presentation, I think the biggest takeaway is that taxpayers are going to still need to have good books and records. They may still need to rely on a crypto accounting software, and that will probably end up being the source of truth rather than what's reported on a 1099 DA. We'll talk about how to reconcile that going forward. Raj, I see you went off mute, so I imagine you have.
I just out of curiosity, for could brokers report based on taxpayer location? Is there any directive from the IRS on that? I don't remember seeing it, but interested in yours and others' thoughts on this.
Jessalyn, you go. I think you're better equipped for that one.
Yeah, I was prepared to answer this one. Brokers will not be reporting at the taxpayer's time zone. The regulations don't allude to it, suggest it, or create it as an option. And practically, it doesn't work. There's a whole lot of knock-on effects of that, because brokers have to reconcile their 1099s and tax withholding with the IRS, and that all has to match, and you need to have a single calendar year around it and say, here's how much tax withholding I took, and here's the year I took it and the 1099 that it went on. And if you were doing reporting based on taxpayer location, none of that would work. So for taxpayers that do have this situation in this example, I would not even bother contacting the brokers and asking for an amended 1099 because they're simply not going to issue it. They would have issued in this example in accordance with the requirements.
Yep. I think, the last bullet point here is just kind of more of an FYI than anything. And once again, a reconciling item. If you're a taxpayer or if you have a client that has a self-directed IRA held at a broker or a custodian, they will also receive a 1099 DA as a part of this regime. Even though IRAs are generally tax exempt, still going to get a 1099 DA in this scenario. So something that's going to have to be reconciled.
And maybe I'll just quickly jump in on that one. It's a practical reason. The brokers don't have a way to exempt these accounts from 1099 reporting. Again, back to the earlier statement about there's a list of requirements, and then there's a list of nice to haves and optionals, and building the infrastructure to actually exempt self-directed IRAs from getting a 1099 is optional. And so it just hasn't made its way up into the hierarchy. So it's more just a practical outcome of being unable to exempt the account. And you don't have this issue in normal IRAs because let's say you've got an IRA at Schwab. Schwab is both the custodian and the trustee. And so they're allowed to exempt the account without needing to implement all these other procedures. There's sort of a simplified procedure available to them. So it's not a tax guidance need. It's just a practical reality.
Yep. All right, let's move on to the next slide here, and I'll try and be quick with these next couple in the to be time friendly. So again, some taxpayer and advisor challenges continue, just a few more. We mentioned this earlier. IRS FAQ webpage has not been updated in quite a bit of time. Now, IRS has continued to update their IRS digital assets webpage, and there's a lot of great resources out on that webpage, and they link directly to guidance that's been issued, including these final regs. If you want to go read all 400 or so pages of these final regs, you're welcome to. They link directly to it. But just something to be aware of, but also FAQs in general. You can't rely on those, right? They're not a source where taxpayers can rely on and use that if selected for an IRS exam or challenged, so on and so forth. So, and then we talked about this a little bit as well. Misinformation on the internet. I think the most common misinformation I see is that 1099 reporting regs were repealed in total, and that brokers don't have to report any 1099 DAs at all. That's factually incorrect. And then finally, there's new Form 8949 checkboxes, and I'm excited to go to the next slide here where we actually have a screenshot of these of the draft 8949. And so what I want to draw your attention to here on this screenshot is actually about middle of the way, maybe even a little bit further down, where it has checkboxes A, B, C, G, H, and I. And you may notice, well, why does it skip? Well, G, H, and I are new boxes on this draft form 8949 for 2025. And these are how taxpayers are going to report the information that is reported to them or not reported to them on a 1099 DA. So this is the short-term page for the 8949. It looks very similar on the long-term. There's 3 new checkboxes on the long-term as well. And so how I like to think about this as a practitioner, and once again, this is all conceptual for the time being. We'll see how this actually plays out with taxpayers come January and February. But if it is reported, if you receive a 1099 DA, if you as a taxpayer receive a 1099 DA that shows basis was reported to the IRS, you would check that box G and report that on the line here, okay? Now that's not going to happen in 2025 because brokers don't have to do that. So brokers are not going to do that because if they did do that, it would expose them to additional penalties if there was something to be reported incorrectly. So I expect that checkbox G to not be used at all or very little in 2025. Where most of the action will happen is that checkbox H, or also the corresponding checkbox for the long-term transactions, where it says transactions reported on Form 1099 DA showing basis was not reported to the IRS. So if you receive a 1099 DA, you're going to have the description of the property, the date acquired, and then you're going to have the proceeds amount on a line. And I would expect that the IRS matching system would expect to see the same numbers that's been reported to them. So what we are going to more than likely be encouraging our clients to do is report that on a line item. But because there are transactions that are not captured by a 1099 DA that may be in the client's books and records, we'll drop down on a separate line and check that box I, where it says short-term digital asset transactions not reported to you on Form 1099 DA or 1099 B, and that will be where the rest of the transactions show up, or even a reconciling item to get to the totals that match the taxpayer's books and records. All right, I'll pause there, see what other folks have to add here. Okay, not hearing anything. I must have covered it all, which I don't think is the case, but if you have any questions, we can follow up on those later. And so I think that wraps up my section. So this, I think now is over to Jesslyn, if I remember correctly.
Yeah, so I'm going to skim through a bit of this just because we're running a bit short on time, so we get to the CARF discussion and just some other guidance topics. Broker challenges, so we're still on the topic generally of the Form 1099 DA rollout. We already talked about a few broker challenges. Brokers have limited time, limited resources to get this all in, and they prioritize requirements over nice to haves. As part of what they are working on, it's still this ongoing challenge of assessing which entities of theirs are in scope or out, and what products are in and out, what products are qualifying stable coins, what products are not, what products are deferred under Notice 2024-57. There's going to be lots of challenges with state 1099 reporting. That's a very sort of technical XML schema issue. We could, again, talk for almost an hour on that topic, but we can go ahead and go to the next slide, where I will briefly touch on the FAQs that the IRS put out on October 30th. It was wonderful that we had that published. More guidance was great. But there was nothing groundbreaking or shocking inside. From most practitioners' perspective, what they saw in there was how they had been interpreting most things. But one thing that I specifically want to highlight is CPAI. So Nick mentioned earlier, CPAI is specifically only for knowing which lots to dispose of when a taxpayer has chosen HIFO, LIFO, FIFO as example. And there's a box on the 1099 that says, check this box if the broker relied on CPAI for this disposal, this asset disposal. And the FAQ basically confirms that as soon as a broker accepts CPAI, from that moment forward, every single sale or exchange will have that box checked, even if that specific sale was not affected by the broker having accepted CPAI. And the only way to really clear out that box and to never have it checked ever again is for the taxpayer to have disposed of every single asset, gotten rid of them, and acquired new ones, or transfer them out and bring them back in. Why does it matter? Again, we don't have to go into the deep details, but this box impacts whether taxpayers can get penalty relief in case of like underreporting of sales of digital assets and cost basis. So that's why the box even matters. If we go to the next slide, missing clarity. So this examples, there was a number of examples that the FAQs go into about what is CPAI. And unfortunately, there's the most common use case, the most common way that customers would like to provide CPAI, and the most common way that brokers would like to accept CPAI is by allowing taxpayers to link up their what we call retail crypto tax aggregator software, because they've already done years of work mapping and linking things and putting in basis where it was missing. And we live in a really, technologically advanced era where we'd just like to connect that in and call it CPAI. But we don't have an example that says that really, really common fact pattern is allowable under the following circumstances to be called CPAI. So that's one thing we hope to see clarity on in the future. With that, we can move to the next slide, and we'll jump into the CARF. I'll go ahead and kind of get into the content delivery really quickly, and then I know Raj and I'll have a little back and forth on this topic particularly. So we'll go one more slide. Okay, so quickly, what is the CARF? It stands for Crypto Asset Reporting Framework. It is a standard set by the OECD, and it is adopted by member states, or not member states, but countries around the world that say, yes, we will adopt this standard. And so long as we all adopt the CARF standard in a similar way, we'll get local reporting of crypto assets, for tax reasons, and then countries will share that information cross-border with the home country residents of the taxpayer. What this is aimed to detect is where a taxpayer is holding crypto outside of their country of primary tax residence. And in some cases, it might actually be used to pre-fill a taxpayer's tax return and sort of pre-calculate any tax they might owe in their home country. And the US back in 2023 announced that they announced a intention to participate in the CARF, which was a big deal. We probably don't have time to get into the history of that, though Raj will fill in some of those details. So that was more than 2 years ago. As of November 14th, we could see that the CARF regulations in draft were in White House review. We can also see through the web link, this is all public information, that the CARF will be implemented through 6045 regulations, which seems unusual because broker reporting is 6045, FATCA and non-resident alien foreign people withholding is in 1441 and 1471. And also, contrary to news headlines, there is no new tax that is proposed on holding foreign or domestic crypto. Though U.S. citizens or green card holders living abroad may have wealth tax in their local country, the CARF does not introduce new taxes. Nothing changes. And then sort of the last update here is as of November 24th, I say the U.S. quietly postponed implementation by 1 year of the CARF. Quietly meaning in the original 6045 final regulations, the IRS stated their intention for 2027 tax transactions to be reported first in the CARF in 2028. The OECD maintains a list of countries that have committed to the CARF and the dates that they've committed. And in the OECD's public document, there was an update where the US went from 2028 reporting over 2027 to a 2029 reporting. We don't know the details of that. The US government, the Treasury, IRS, they have made no public statement about this. We will just see when the 6045 regulations are published for public comment. We'll see the details in there. So Raj, I will hand to you because, from a policy perspective, there's a lot of interesting background and developments in this area that's up your alley.
So I think, thanks, Jesselyn. I think that was a really comprehensive thing. Look, when you look at, as a former regulator, right, when you're looking at regulatory intent and policy intent, I think there are a few things that one has to keep in mind. One of the things goes back to the fundamentals of what is crypto supposed to do. It is supposed to have taken out intermediaries and allowed for a global peer-to-peer exchange and creation of whether it's capital or whether it's collateral, etc. Currently, when you look at custodial regs and sort of where things are, for the most part, the bread and butter exchange of tokens are pretty regionally geofenced, right? And I think one of the things that the automatic exchange or the exchange of information between the OECD's CARF regime and the US was supposed to have done is to, and I dare bring up something that we all dread, which is sort of a FATCA CRS sort of exchange of information where, yes, on one hand, governments would have access to information of each other's residences, but then on the flip side of that, it opens up and makes the participation more global, right? But there are also challenges to that, which is, and we've gone through it with FATCA and CRS. Anybody that went through the whole self-certification nightmare knows that there was a lot of money and a lot of time spent, and it's debatable in some people's minds whether the ROI was there or not. So I think from a policy perspective, it was, it made sense to have this exchange of information. If you look at just the OECD side, and Jesselyn correctly said that it's not just the EU countries, right? Like Singapore and Switzerland, some of those others are adopters of CARF, although Switzerland recently delayed implementation. I think what the OECD was trying to do was to allow some sort of an international alignment, right? By creating a uniform disclosure standard that jurisdictions can adopt, that could probably lead to regulatory fragmentation and arbitrage, and give some sense of fair and consistent taxation by ensuring that taxpayers that have multiple jurisdictional residences can report income and gains in a fair and consistent way, and they will be treated as such. And finally, to give more credence to financial institutions' reporting structure and consumer confidence, it was intended to reinforce, or it still does, AML transparency and financial integrity objectives by linking such things as identity verification, transaction reporting, and cross-border data exchange. Now, one of the major challenges in CARF is that there's the OECD, and then there is what member jurisdictions or national jurisdictions do in implementation within its own framework, right? And I think you've seen a lot of those challenges currently, and then that puts the financial institutions or the crypto native institutions that have reporting obligations in a bind, because business has to go on. And what do they do in terms of actually creating reports and spending the money and ROI? So I think we're at a really interesting point. The delay is not surprising to me of the US adapting. I think this is just my personal opinion. I think part of it is because the DeFi regs were CRA'd in the US, and CARF does not wholly have an exclusion for non-custodial products. So I think we got to sort out some of that stuff on the US front as well to come into line with some of the CARF requirements. So, Justin?
Yeah, maybe I'll just add one last comment on this topic, and then we'll see if Nick or Daniel have something, and then I think Daniel has one more slide we will have time to get to. The scariest thing to me about CARF for U.S. brokers, let's say, the U.S. crypto institutions, is right now these brokers are getting tax ID numbers for pre-existing customers and getting those validated. They are getting W-9s and W-8s for their new customers starting, very shortly. All this stuff, it's a lot of work. And W-9s only tell you if someone is a U.S. citizen, green card holder, or a resident or not. They don't tell you where that person might otherwise be tax resident. When the CARF comes in, these brokers are going to have to repaper everybody under a new sort of certificate in order to know where they are tax resident. And I'm not saying that because I know what's in the draft 6045 regs. I'm saying that from a principle of what information would the US need to be able to exchange tax data back to other countries. They would need to know that person's tax residency, and W-9s simply don't collect it. So
yeah, and I think
there's right now a big papering event,
yeah.
And there's going to be a repapering.
Yeah. Look, I think that's a very valid point. I think that maybe the self-cert will help, maybe not. I mean, we know that even in the case of CRS and areas where self-certs were accepted by U.S. institutions, it didn't lower the burden of paperwork. But let's at least hope. I'm seeing the glass half full, at least on the reporting side. I hope that the draft regulations will have symmetry with schemas that are already out there in the OECD in terms of the information that is required for reporting. So at least we don't have a disconnect there that we did in between the FAQ and the CRS regs, right? So, all right, Daniel, I know you have one more slide, and we have 2 minutes.
Yep, I can go over this really quickly. So finally, these are some issues that I think practitioners and taxpayers really need to know about, because there's either no guidance and we're awaiting potential legislative changes, or there's non-authoritative guidance issued by the IRS. So one example is application of 475 regarding mark-to-market accounting. It really remains uncertain, because although there's certain digital assets that are actively traded and have reliable market valuations, digital assets are not clearly specified under 475. And then on the informal guidance issue, the IRS issued a memo stating that the qualified appraisal exception for charitable contributions does not apply to contributions of digital assets. They essentially determined that the plain language of 170 F11 does not specifically provide for that, and therefore they can't allow that charitable contribution they can't allow that exception. So a lot of these items, they could be addressed by legislation, whether it's Senator Lummis's bill, which was introduced earlier this year, or some other version of it. But regardless, it's just important to know that these issues remain either outstanding or informally addressed by IRS as of now.
Thank you, Daniel. And to that, I will add one more thing. You guys may have noticed that Treasury asked for comments regarding implementation of Genius. So outside of everything we've talked about, when you talk to customers, they are, especially from a greater beyond just tax side, are interested in what's happening both on the implementation on the Genius Act as well as the future of things like clarity and market structure, right? So I want to thank our esteemed panel for all of their information and all of their knowledge. As many of us mentioned, we could talk for 2 hours and we would not cover the basics of it. So I will pass it back to Ron at Wall Street Blockchain Alliance for outgoing comments, or any of the panelists that may have a comment as we close out. Otherwise, I will wish you all a very, very happy holiday. Anyone on the panel want to say last minute things?
Raj, Dan, Nick, Jesselyn, thank you so much for your thought leadership. I don't think we have any additional questions. If anyone in the audience has questions for our expert panelists, email us, please, info@wsba.co. We'll leave it there. Panelists, again, as always, thank you so much for your expertise. It's always a privilege. We'll end it there, everyone. Have a great rest of the day.